Welcome back. It's time now to take a look at what's making the business headlines. In our top story, a number of initiatives introduced by the Abu Dhabi government are to have a positive impact on demand within the Emirates real estate sector. That's according to Jones Lang LaSalle's real estate market overview for the second quarter. Initiatives such as the recently announced 3-year residency visa for property owners, a new tenancy registration system, and a new law limiting overcrowding in residential properties are said to be potential major contributors to boost the sector. Jones Lang LaSalle also stated that reducing the cost of living and doing business in the capital improves the Emirates' attractiveness for residents and companies, thereby facilitating future growth.
Another government intervention is on the supply side, and they're trying to reduce the amount of future supply of real estate, cutting back on projects, delaying projects to make sure they're more in line with demand. So all of those initiatives, we believe, in the long term will be a boost to the market. But over the short term, over the next 6 to 12 months, the market will probably continue to deteriorate and prices will continue to fall.
Inflation in Abu Dhabi rose 2.4% year-on-year in June and 2.5% in the first half of the year compared to 2010. That's according to figures released by the Abu Dhabi Statistics Center. The data showed that the price rise in the capital was mainly attributed to higher food prices, for instance for meat, which rose by 13.5%, followed by coffee, tea and cocoa products, which rose 13%. The next largest contributor to the overall year-on-year increase in the CPI was the housing, water, electricity, gas and other fuels group. Meanwhile, the average price for clothing fell by around 16%. Analysts forecast that inflation in the capital will remain low this year due to a price stabilization initiative from Abu Dhabi's Ministry of Economy. Etisalat, the UAE's largest telecoms carrier, posted a second quarter net profit of 1.6 billion dirhams. That is lower than last year's income, as operating costs rose amid increasing competition in its home market. The former monopoly, which operates in 18 countries, has been facing tough competition at home, which is its key market. It contributes more than 70% of Etisalat's total revenues. Also, staff costs in Q2 rose over 17% to 1.3 billion dirhams compared with a year ago, Etisalat said in a statement. Second quarter revenue came in at 7.9 billion dirhams, down from 8.1 billion a year earlier. And let's now take a look at the local and regional equity market. Shares in the Gulf region took a hit today as the EU and the US debt crisis weighs on investor sentiment. And in our world business news, gold hit a record high on Monday, surging to $1,600 per ounce for the first time in history, as the EU and US debt crisis and a banking stress test in Europe once more spurred investors' concern that governments are struggling in dealing with mounting debt. Also, stocks weakened, especially banking shares, and the euro tumbled against the Swiss franc and the yen, as investors seek safe haven assets. European leaders are holding a special summit on Thursday after 8 mainly Spanish and also 2 Greek banks failed the stress test. ECB President Jean-Claude Trichet, meanwhile, reiterated he won't accept bonds as collateral from a nation with a default rating. Gold soared while the euro fell today. Earlier, we asked Gaurav Kashyap, head of DGCX trading at Alpari Middle East DMCC, what the way forward will be for the precious metal and the single currency this week.
Well, Linda, the euro is going to remain under pressure. You had brought up the point about, no more further solutions regarding the EU sovereign debt crisis. We foresee this to be the case up till Thursday, whereby we should see a big market risk event, which will be the EU summit, which is taking place this coming Thursday. At this summit, they'll be discussing the second Greek bailout package, and only then we could see some kind of, once we see some kind of closure to this issue, we can see some kind of risk sentiment coming back into the markets to reverse the trend in the Euro-USD. Up until that moment, we should see risk sentiment capped, which means Euro-USD is probably primed to test about 139.10 on the Euro-USD pair. Of course, the hottest pair these days is the Euro-Swiss franc. Of course, the combination of a weaker euro and a stronger Swiss franc, because of its safe haven status, has seen it hit new all-time lows at 1140 levels. we can expect the downside to continue there. Another interesting pair is, of course, the gold, as you had mentioned. Gold seems to be continuously benefiting on all this uncertainty in the markets. Of course, the US debt ceiling is also helping support gold. The EU sovereign debt crisis, we saw Italy and Spain recording all-time highs on their 10-year bond yields. These are similar to the levels we've seen in Ireland from last November when they requested a bailout. So overall, we look at more upsides in gold, but once again, this could also reverse if we have some kind of closure in the market.
Ernst Young cut its economic growth forecast for the UK from 1.8 to 1.4% due to weak consumer spending. This is the second time that the London-based company has cut its forecast for the UK this year. Ernst Young also lowered its GDP outlook for next year from 2.3 to 2.2%. In a statement, the firm's chief economist warned that the UK is at a crucial juncture where recovery is failing to gain momentum as inflation is at more than double the Bank of England's target. High inflation is squeezing consumer incomes. Ernst Young added that prospects for exports, however, remained encouraging. Before we go, here's a quick overview of the oil and currency markets, and after that, Laura Buckwell is back with the day's sports news.